Okay, so what are we gonna talk about? Let's get going. This is gonna be part two. This has got the most in it. It's for, unless you're doing a lot of partnerships, S corps, trust, C corps, this will be a little more challenging. The first 6 chapters, you already are gonna, it's gonna be fairly easy. So just get the reading done and the thing, and you'll be good. Then we're gonna get into corporations, partnerships, corporations, S corps, trust, and retirement plans at the very end. It'll be from the corporation standpoint as opposed from the individual standpoint on all the retirement plans. Okay, so what do you gotta know? All the business entities, they're pretty common. If you don't know this, what we talk about today, you shouldn't have been in here anyway. Sole proprietorship, it's not a legal entity separate from your 1040. You have unlimited liability, business can't be transferred. So what happens if you want to sell your sole proprietorship? You're selling the assets in the sole proprietorship. If, this is not really for right now, but if you have assets, all your tables, chairs, computers, printers, that kind of stuff, and it's worth $10,000, but you want to sell it for $100,000. Well, you're going to sell all of those. You're going to put a value on it. The other guy puts a value, and you have to fill out a form, and it goes to the IRS. Is everybody familiar with that? I can't remember the form number. I haven't done it in years. But anyway, you list all of your assets, their fair market value, and you and whoever you sell your company to both puts that form on their tax returns and send it. That way the IRS goes, it's reasonable, because they're not, the guy you're selling it to is not gonna let you put an old clunker computer down there and say it's worth $1,000. You really wouldn't want to do that anyway, because then you probably already written that thing off and have to pay tax on the whole thing. Okay? So if you're selling a sole proprietorship, you're selling all the assets, and if all your assets are worth 10 grand and you're selling it for 100, the other 90% would be goodwill, employees in place, what other kind of stuff? Leases, if you have leases, things like that. But those things all get taxed at capital gains rate, so that's a good thing. All right. If you have a husband and wife, you can have a qualified joint venture. They may still ask them questions about that, but they don't ask much.
Hello, sorry.
Hello, come make yourself at home. Okay, we're changing from page 7 to 8. And we're talking about what are the different kinds of entities. We're gonna go sole proprietorship, S corp, C corp, partnership, limited liability companies. A limited liability can be, that's the next page, but you can have a sole proprietorship that's a limited liability. You can have partnership that's limited liability. So you can have sole proprietorship, limited liability, partnership, limited liability, S corp, limited liability. And I know a guy, I have a friend that every time he makes an S corp, he all makes some limited liability S corps. And I don't know why, but he does. What does the limited liability do? It keeps your risk down. Less likely to get sued for everything you got. Okay, so sole proprietorships, corporations, a regular corporation, what's the disadvantage? You got double taxation. The corporation pay tax on its income, and then you pay tax on the dividends, or somebody does. Remember, a sole proprietorship just is its due on April 15th with your tax return. A corporation, starting a couple years ago, it's now due on April 15th. A partnership and an S corp are due on March 15th. Everybody got that? And then 6 months later, they're due on September 15th. Why do you think they did that? Because so many of these mean people that do S corps and partnerships were waiting till the last day to get them out. And then if they had to send a K1, Well, that person that got the K-1 was late with their tax return. And so it's still cutting it close if they get it done on September 15th and get it in the mail to you. Okay. A closely held corporation are subject to the at-risk rules. If both of the rules apply, it's not a personal service corporation, and this is the key, more than 50%. So the trick question on the test that says the guy owns exactly 50% of a corporation. So is it a closely held corporation? No, because it's not more than 50%. One year they caught me on that. And I thought that was a trick question. They didn't care. So you can make an election to be an S Corp instead of a C Corp. We'll get into all of that in later chapters. So what's the difference in an S Corp? An S Corp is a pass-through. You don't pay, the S Corp doesn't usually pay tax. What happens? The S Corp gives out on the proportion of your proportion of the income, gives you a K-1. The K-1 goes to the individual, goes on the individual's tax return. Everybody's pretty much got that. Okay. For the most part, S Corps are required to be a calendar year, and S Corp is due on the 15th of March. Partnerships do not pay taxes. They're like an S Corp. They're a pass-through entity. All their income goes from the partnership, gives out a K-1 again, and it goes to the individual. What's the difference in an S Corp and a partnership? One of the big ones is all the income you on that partnership is subject to self-employment tax, both your guaranteed income and any other regular income. Okay, and an S Corp, not. But an S Corp, if you're a active participant, you should be an employee, and they have started to crack down on that. One of the fellow students, he and I have been friends for 15 years. He was in this class 5 or 10 years ago, and we used to argue about that. Going, I'm telling you, you need to have these people being an employee, or one of these days you're going to get in trouble. He now has decided that that's a good idea. He went to enough seminars, and they kept saying over and over again, if you don't give somebody a W-2 and an S Corp, let's just say it's a single member S Corp, we're going to get you. So, beware. Okay, limited partnerships. So, you can either be a general partner in a partnership, then you have unlimited liability. Good evening. Come have a seat. We can make you a seat up here. You can have the prime chair if you like. Sorry, all of this is, my son went to the North Shore early this morning to surf. And he put one of these little video cameras on his head, I guess, or somewhere, and brought back him surfing the big waves. More brought back him falling while trying to surf. But it didn't matter, he was happy. Okay. Limited liability partnership is not responsible, such as a general partner. What's the disadvantage of a general partnership? You're responsible for all the everything that happens in the partnership. Okay, a limited liability partner is not. Okay, LLC, a limited liability company, is a domestic entity. First rule, limited liability company. It's not limited liability corporation. Have you ever heard anybody say that to you? They come in, oh, what are you? I'm an LLC. Well, LLC doesn't mean anything to the IRS. Huh?
Oh, yes.
Yeah.
We love you.
Oh,
Party time.
LLC, so you can be an LLC, sole proprietorship, corporation, you can be an S corp, you can be a partnership, LLC. And what does that do? It limits your liability. That means they can only get you pretty much for what's in the corporation. Although in real reality, they can pierce the veil of your LLC, sole proprietorship, or partnership, or whatever, and still get you if they got a good sleazy lawyer. That's a personal opinion. I don't think it's in the book. Okay, there's a list of things that LLCs do. You can read that as well as I can. Single member LLCs are treated as disregarded entities. That means it's just the same thing as a Schedule C. Everybody pretty much aware of that? An LLC partnership is pretty much like a partnership, but you got limited liability. Entity classification election. An eligible entity can fill out this, you need to know, 8832 to elect how to be classified for federal tax purposes. Corporation, partnership, or entity inseparable from its owner. You don't have to fill that out if you're going to be a Schedule C, though, by the way. Then, where does the other form go? We may not have gotten to it. Okay. You can file the 2553 to elect a classification or change its current classification. So if you filled out the 8832 to become a corporation, and you immediately fill out the 2553 to be an S corporation. Are everybody with me on this? And unless your boss forgets to do it, and then for a few years. Okay. Unless you've made an election on an 8832 to be a corporation, or then to become an S corp. Then if you're not, if you only have one person, you're a sole proprietorship. If you have two or more, the default is partnership. They like to ask that question a lot of years. And it says summary of business entities. You guys can just read that. Trust and estates are separate entities from their owners. Trust may be created to hold assets. But what about if you have a grantor trust? Okay, so we're going to wait on trust until the end. An estate comes into play after a taxpayer dies. We went through estates on the other chapter, but they're liable to have something in there. If you have an estate and the money is given to the beneficiaries, then they pay tax. If it's kept in the estate uses a 1041 and it pays the tax. And it would pay a higher tax rate, so it's good in some cases to pass the money through to whoever gets it, because they're going to pay a lower tax rate. Such as you have like an IRA. So you just pass that straight through to whoever gets the IRA, and they're liable to pay a lower tax rate than the trust. Everybody pretty familiar with all this stuff, I hope. Okay. What do you use to file? If you need to file an EIN, you have to use an SS4. Believe it or not, that's one of the gimme questions. You want them to go, yes. What do you do to get an EIN? SS4. When you get questions like that, you'll be going, thank you.
Yes.
Does a sole proprietorship need to file an SS4? Answer is no, unless they have certain reasons. They got employees, They got a pension fund, something like that. If a corporation incorporates or enters into a partnership, a new EIN is required. Returning and payment of employee taxes for employees of an LLC must be using the name and the EIN of the LLC. That applies here in Hawaii. So if you, same thing with GE tax, which is not part of the class. If you become an LLC, then you have to have an EIN, and you need to be filing under the LLC name. So in my case, if I had Hank's Tax Service, I change to become Hank's Tax Service LLC, I have to go get an EIN, and even my employees, I'd have to start filing under the new EIN. I actually have an EIN, but I think I'd have to get a new one for LLC. Do not use the EIN of a prior business unless a taxpayer becomes the owner of a corporation. Okay. They've got something in here, principal business or professional codes. You know the little codes that, how many times have you guys ever used 999 instead of going and looking it up? I'm kind of guilty of that too many times. Does everybody know what we're talking about? You know, like especially for Schedule Cs, for businesses, you gotta tell them what kind of business. So if I'm in a doctor, lawyer, construction, medical, whatever, you have to go look up in those long lists what you are, and if you can't find it, you use 9969s. Okay, I don't want to teach you bad habits. Yeah, if there's some, there isn't any for some things.
Is there a wrong answer for that?
Not really.
Like, what if you find something similar?
Close, that's where it still work. Even if you put something just completely wrong, nothing happens. There's not a penalty for doing that unless you're intentionally trying to deceive somebody, maybe. Okay. Constructive receipt, under the doctrine of constructive receipt, somebody gives you a check to pay you for something on December 29th, and you go, oh, I'm gonna just hold this check and deposit it in January. Wrong. Constructive receipt, they gave it to you, whether you deposit that check in January, it's still your income. Everybody got pretty much how that works? Or if they gave it to your company, to your employee, because you're on vacation the last month of December, it's still you've constructively received it. Okay. Economic benefit of properly received included. So, I have my favorite employee, Bay, and I say, Bay, here, I'm gonna give you a car to drive during tax season. In effect, I've given him a benefit, and that's taxable income. Whatever the value of that is, we have to put it on his W-2 and count it as income. Income not constructively received, I go, I'm gonna give you a bonus. I'm gonna give you half your bonus now, and if you make it through the end of tax season this year, I'll give you the other half. So when I give him the first half, it's, let's say, at the end of this year, I give him the first half. And say, I'm gonna give you that other half after you stayed with me for 6 months or a year. Then the first half that I give him is taxable now, but since I'm not really, even if I said I'm giving it to you, it's not really yours until you can actually spend it. So it would not go on this year's tax return. It's on next year's. Okay, so, and I'm missing some pages here.
Accounting method.
Okay, so we should be going to 14. Dividends are another one, constructively received when made subject to an unqualified demand. So, you get dividends or interest, they put it in your bank account, you don't get the money till the next year, you still got it this year. So everybody understands that, those are pretty, hopefully, but they have a bunch of those little questions in there. Those are the ones you go, yes, I'm lucky that I like that one. It's a lot easier. Okay, when a bond is sold between interest payments, the interest accrued up to the date of sale is added to the selling price of the bond. Okay. I have a $10,000 bond. It gets $500 of interest this year. I keep it through half of the year. The interest actually goes over here, but so I sold it halfway in between. So $250 goes to the one guy that buys it. The other $250 goes to me. Everybody pretty easy on that one. In a few weeks, when we get down to basis of partnerships and corporations, we're gonna be back to the blackboards again. And I'll probably give you some little sheets to make it easier. And the answer is, you're gonna have to be able to figure out basis for partnerships and S corporations. Does everybody know that starting this last year, now you have to calculate, if you're the tax preparer, you have to calculate the basis of someone's S corporation. And not the guy that does the S corporation tax return. It's the preparer that gets the K-1. So when you have that customer that comes in and you go, well, what's your beginning basis? He looks like a deer in the headlights and go, what's basis? Houston, we have a problem. Okay. Prepaid rent. Prepaid rent is rent when you get it. So you pay rent in December, you're not supposed to write off prepaid rent if I pay it to somebody else. But if I get the rent in December, it's income to me when I get it. Does everybody understand how that works? If somebody comes in and they go, I'm gonna give you the first last month's rent and a deposit. Well, the first and the last month rent is income and the deposit is not. It's a deposit. And when you give the deposit back, it's not an expense. Okay. Number 4 under H is advance rent payments must be deducted as an expense by the payer during the tax period in which the payment applies. I've probably been doing this wrong for 30 years. But I've done it the same way for 30 years. I pay rent, sometimes you pay it, it only matters in December. But if you pay the rent before the 1st, technically my computer, if I write the check on the 27th, it puts it in that year. Well, it probably shouldn't be. But I've done it that way, same way, consistently forever. And even if they ding me for it, I'd go back to the next year and the same thing would apply, so I'd move those forward. It'd come out approximately the same. But what they're saying is if you pay for rent in 18 that applies to 19, you gotta count it in 19 as an expense. On the other hand, if you collect rent in 18, you gotta count it as income. Is that fair?
So it doesn't matter if you're on a cash basis.
Huh?
It doesn't matter if you're on a cash basis, and if you prepay the rent, you would have to.
You're not supposed to write it off. If it's, now, anything but something big, the truth is I don't think anybody's gonna care so much, but I'm probably not supposed to say that to you. But that's the rule. And on the test, that's the way you're supposed to. Does, yeah. You guys may know something I don't. Okay, cash method tax preparer deducts expenditures when actually paid, except for prepaid rent. Bad debts. I'm a cash basis taxpayer. Can I write off my bad debts? I had somebody, I did his tax return. He owes me $200. He stiffed me for the $200. I'm a cash basis taxpayer. I don't count the income until I receive it, so I can't have a bad debt for not getting paid because I never counted his income. On the other hand, if I was an accrual basis taxpayer and I counted it as income, then I could take the bad debt when I realized it was a bad debt. What about bad checks? I've got somebody gave me income for a bad check, and the bad check comes back. I can count as, I don't have to count it as income.
What's the name of that deduction? Bad debt.
Bad debt.
Oh, okay.
Bad client. Bad client.
That's it.
I made it through this year with only one hot check. I've never been that lucky before. Most people are now not paying with checks. Credit cards, debit cards. Okay, advance payments. Well, okay, Cruella Method. Does everybody understand Cruella Method? Accrual method, you write off the income when you earn it. So, the guy, I do a service, I put in a guy's air conditioning system on December 15th. I don't send in the bill until January 5th because I actually did the work in December. It's income in December. Everybody good with that? Same thing with an expense. I go to Home Depot and say I want a bunch of stuff in December, but I don't pay them until January. On accrual method, that's an expense then. Everybody good with that? Is that a good way to say it? There's an exception. I own more than 50% of a corporation. That corporation does some work for me, and I owe them $1,000. No, it's the other way around. I do some work for them. They owe me $1,000. They don't pay me till January. Normally, on a accrual basis, they'd write it off here. I'm on a cash basis, I write it off there. But if I own, what is the key word? More than 50%, then they can't write it off in 18 because we're related parties. They have to write it off in 19 when I write it off. Everybody good with that? That's a trick question that almost every year somebody will get that one. And there's two parts to it. One is the dates, they'll trick you with the dates. The other is the more than 50%. They'll say 50% or 20, a lot of times they just say 25%. And so then it's just a normal transaction. This person would write it off in 18, and that person would count the income in 19. It only applies if you're a related party, more than 50%. Or related party, your father, mother, grandparents, your kids, grandkids, brother, sister, wife, husband. They may ask you about this. Qualifying taxpayers who satisfy the gross receipts test, they maintain they must do accrual basis accounting, but then just go ahead and read all this. Basically, if it's under 25 million, it doesn't matter. I don't have any clients that make over 25 million. So, and most of us don't, but that's still the rule, so go, you need to know it. Generally, C corporations, partnerships with a C corporation partner, or charitable trusts, they must use the accrual method. Who does not have to use the accrual method? Qualified personal service corporations. Who would that be? If I'm an accountant and I'm a corporation, I'm a personal service corporation. Accountants, lawyers, doctors, probably engineers and architects. And there are probably some more people there too, but dentists. They got special little rules. Okay, income for corporates, income is included when all the events have occurred that fix the right to receive it, which means this is for accrual. What does that mean? When I've done everything, when I've done everything that I'm supposed to get the money. If there's still a contingency, then I haven't. So if they're going, you're gonna get this money unless, and whatever that unless is, you can't get the money, then there's a contingency and you wouldn't necessarily be getting it. Unless you get this extra bonus if you stay with me for 6 more months. Then I haven't earned that money until I've been with him for 6 more months. Proceeds from law settlements of a lawsuit are determinable in amount of reasonable accuracy when received. Okay. Prepaid income must generally be included in income. Prepaid income for services may be accrued over a period for which the services are to be paid. Here's the catch, but only if it does not extend behind 1 year. So I make a deal with somebody, I'm gonna give you 5 tax returns over the next year, and let's make it 6, make it 12. And I start, okay, so he gets 2 this year, they count as income. Then if he gets the rest of them all next year, the rest of that income goes into next year. But if something happens and he doesn't get them all next year, and he gets some the year after, they all have to be in next year's income. That's a question they bring in a lot. Does everybody get that? So there's 12 tax returns. I do 2 this year, and if I do all 10 next year, that's no problem. But if I only did 6 and I still owe 4, even though I owe 4 and they get done in 20, I have to count them as 19.
Is that because they've already been paid for? Like in that
Yes.
Okay.
They were paid for in 18, but I only counted 2 of them as income in 18. Merchandise sales when they're shipped, that's number 3 on page 16. But if it's COD, what does that mean? That means they don't transfer from one guy to the next until they're delivered. So if I shipped a bunch of computer apartments to Lynn and they're COD, they're still my computer apartments. They go into my inventory until Lynn gets them. Everybody got it? And if they're not, there's the other word, then when I ship them, they become liens. Okay. I don't think they're gonna ask you that. Accrued vacation pay is generally deductible when paid. Under our current case law, reserved for contingent liabilities are not determinable, so you can't use it. Hybrid method, what are we talking about? So the main two methods that everybody uses is cash and accrual. But you can have a third method, hybrid method, where part of it is accrual method and part of it is expense method. So let's say that we have a big inventory kind of business, and so we use the accrual method for our inventory and our sales. And I believe that if you use it for your inventory, you gotta use it for the sales. But for all of our regular expenses, we use the cash method. That would be a hybrid. So you're using a little of both, half of it's accrual and half of it's cash. And any method that uses both is treated as a cash method. Inventory methods, identification method. So if I was a used car salesman and I had 20 used cars, I'd use the specific identification. Each car, I'd say I paid $2,000 for this one, $3,000 for that one, $10,000 for that one, and when I sold them, I would take the cost of the car as my cost of goods sold. Everybody got that? That's specific identification. I call it specific identification method. They're calling it identification method. Okay, but anyway, that's when you just have. That only works if you don't have lots of stuff that are all the same. But if you're making 10,000 little widgets that all cost $1 each, that doesn't work very well. So what do we use? FIFO and LIFO. Hopefully all you guys got this already. FIFO, first in, first out. It's the normal, what most people use. So I bought $10,000 worth of widgets at $1 a piece. Okay, I bought them first. Then I bought 10 more thousand at $1.50 a piece. I got them second. So when I start selling the widgets, I sell the ones that cost me $1. The first ones I bought, I take them out of the inventory. Hopefully you guys should have this. So I got 100,000 widgets at $1 each, and then 100,000 at $2 each. When I start selling them, I sell the first 100,000. So if I sold 50,000 in this period at 100, that's 50,000. Okay? Then I'd subtract that from what I say I sold them for $5 each. So that's $250. I make good profit. Then I sold the next 50,000, let's just say 40,000, and I'd have 10 left here. So the next time I sold 40 more thousand, I'd take my last 10 here and 30,000 from down here. So 10 would be 10,000, and then $2 times 30 would be 60. Everybody got all that? They're gonna give you one of those problems too, probably. When I say give it to you, maybe only 1 or 2 out of the group will get that problem. And then 1 of the 2 out of the group will get one of the other problems. Everybody won't get all of them. Okay? What kind of valuation measure? Cost. That's the simplest. Why? Cost method is what? You put in all the cost it costs you to buy something. If I buy all my bicycles at $100 each, my cost per bicycle is $100. If there were some other cost associated with it, I had to hire an accountant to keep track of all that stuff. And I paid him, I bought 100 bicycles and I paid him $500 per month to keep track of all that. That $5 per bicycle would be added to the bicycle cost. Everybody pretty much, part of this is so simple that I don't know what to even tell you, because I just assume everybody's got all this. So everybody shake your heads yes, so I'll know that you got it. You got it? Okay. The lower of cost and market, that's another one for sure. The lower of cost or market. So, you bought these things for this, and their market value right now is here. Hold on. Okay, so the total cost was $600. The market value would be $600. I didn't do a very good job. But what you would do, you take the lower of cost or market, and this one, it would be 100. This one, the lower is 300. And this one, the lower is 100. So, your inventory would be 500, because each, and you got to do it for each product every time. And I think for as long as I can remember, they've had at least one of those kind of problems. It won't be much harder than that. One thing you need to know, LIFO is called last in, first out. You can't use lower cost or market with LIFO. You have to use it with FIFO. First in, first out. Rolling average. Basically just read that. You might, they don't usually have a question on that, but they might. FOB shipping point, buyer is responsible. FOB destination, the seller is responsible. So if I call somebody up, Millie or somebody, and say, Millie, I need 100 boxes. And you go, okay, I'll ship them to you. If it's FOB destination, then that's like when they get there, I become responsible. So if Millie ships them to me and something happens on the way, they got caught in a California fire and they get burned up, Millie's in trouble. On the other hand, if it's FOB shipping point, that as soon as Millie ships them, they're my responsibility, and then they get burned up, I'm the one that has to pay for them. Everybody, that's semi-important. Consignment. Who's responsible consignment? I give out some merchandise to you. I have a bunch of antique vases. I give them to you to put in your store. You put them in your store. I still own them, so they're still part of my inventory, even though they're your store. So they're my inventory. I would count them as inventory. You, even though they're your store, you don't count them as inventory because you hadn't paid for them, and actually you're not going to pay for them. Some customer's going to buy them, and then you're going to take part of the money, give it to me, and part of it keep it for yourself. But consignment still, they still stay with the person that owns them. I'm just loaning them to you. Accounting periods, tax year. Everybody has to have a tax year. We usually get three kinds. You have, you get a calendar tax year. That's what most people use, right? Especially if you're not a corporation. Sole proprietorship, almost always. So what is that? That goes from January 1st to December 31st. Okay? Then you have a physical tax year, and it can go on certain things. You got to know this. The trick question they always say is, which one of these cannot be a physical tax year? And it's always going to be April 15th. I don't know if they'll still use that question, but they've had it forever. Okay, so what can you have for physical tax years? You can have the last day of the month on any month except for December. Okay? Then you can have what's called the 52-53 week year, so that you pick the last Friday and any whatever month it is, and that's your tax year. Everybody understand? Or the closest day to the end, to the 31st of whatever it is. The closest Friday to the end. Anyway, those, they don't do that much, but you could have a question on it. Short tax year. Instead of me trying to spend a bunch of time going over that, what happens, how would you have a short tax year? You want to switch from one kind of entity to another, so you're going to go, I want to go to a corporation and or a partnership, and my corporation or partnership, everybody that, let's just say somebody else bought you, another partnership or corporation, and they have a year ending June 30th. And so they're going, we want you to go to June 30th. So you have you've been a calendar year, so you have a short tax year from January 1st to June 30th. Then they have a short way of doing this. You take the months over the short year and calculate. So you'd have your income for that, but then you would annualize it. So let's just say 8 months over 12. Well, you'd put 12 over 8, multiply that times your income, and it brings your income to what it would be for the whole year. You can read that as easy as I can. What is the form that you do to change? The 1128. They may ask that if they're tricky. And the 8716, I don't really remember much about that, but this is called the Section 444 election, and what that election is you want to have a change in your tax year. We're going to go back, when we get into the corporations, partnerships, we're going to get into that a little more. Okay. We're rolling right along. I'm going to run to the restroom real quick. I went through an entire Diet Dr. Pepper, the big ones, before class. Probably not a good idea. And everybody else that needs a break, we'll have a quick 5-minute break. You know what, I forgot to turn the air conditioner on. Does anybody want the air conditioning on, or are you guys all happy the way you are? Okay. It's finally starting to cool down, I don't know if you've noticed. It's a little humid still, but it's cooling. It's not in the 90s anymore. Okay, income and forms. Gross income, there's a whole list of all the things that are gross. Oh, we'll wait. These next couple weeks are gonna be your easy one. Hopefully everybody knows we're gonna go like, chapter 3 is business expenses, chapter 4 are other deductions, and really it's just the like automobile, travel, the trickier expenses. Though that's another easy week. Then 5 and 6 are not going to be as easy. 5 is basis, and 6 is depreciation, and then it goes downhill from there. So, well, it depends. If you think partnerships, corporations, S-corps, and trusts are easy, then it'll be a piece of cake. The only thing that's going to be a little challenging is we're going to have to figure out basis for all these. You haven't been doing that all along, though. Uh-oh, duck. It could be after. Okay, gross income. We're on page 38. All income from a trade or business, from the selling of products or commodities. Gross sales minus cost of goods sold, plus other gross income, rents, etc. Gives you gross income from a business. So what does that mean? You get to subtract, for gross income, you get to subtract cost of goods sold. Okay? And then after that, after gross income, you get to write off all the other expenses until you get to net income. Generally, amounts that are received in advance for future services are required to include in the year of receipt. As we said before, if you're accrual basis and you get it and part of it's for this year, part of it's the next year, you can put part of it in the next year. You can't go past 1 year. Discharge of debt, cancellation of debt. My favorite, the old 1099-C. So, if you get cancellation of debt, that's income to you in most cases. Unless what? You've got a bankruptcy or you're insolvent. I don't know how far they're going to go into being insolvent. I haven't seen a lot of problems. I haven't had anybody audited when we put down on the 982 that they're insolvent. But we don't get a lot. We haven't had a lot. The economy's been rolling pretty good, so most people aren't. Does everybody understand when you have a cancellation of debt, that's income to you? Unless you're insolvent or bankrupt and you used to, or it would be an expense if you put it down as income. I have not written off. I owe $3,000 to the guy that fixes my car. I haven't paid him, but, so I didn't write it off as an expense, but it's 100% business expense. So if I put the 1099-C on there, then I could also write off the expense for the equal amount. What if a creditor generally cancels a debt, the amount forgiven is treated as a gift? Very nice creditor. Huh?
Very nice.
Yeah, gross income does not include discharges that occur in bankruptcy or insolvency or related to a qualified form indebtedness. Okay. Okay, so we have a 982 and we go, this guy got out of $50,000 of debt because I'm insolvent. But I happen to have an NOL that I haven't used up because I'm insolvent. I've been losing money in my company. Well, then I would have to reduce my NOL. What else did it say? General business credit, capital loss carryover, or basic basis reduction.
In that order.
Yes. And I think the order may be important. This is one of those things you don't see but maybe once every year or 5 years, and you go look it up in real life. This is the right answer, but for your test, maybe not. But what you really need to do is that you need to know that if you have a discharge of debt, you have to reduce your basis or reduce the NOL or the capital loss carryover. So you had you lost 50 grand, you wrote that off, you were insolvent, but you had a giant $100,000 NOL, you would reduce your NOL to only 50,000. Okay. Examples of other taxable income. The recovery of an amount previously deducted as a bad debt. Okay, so here's the trick question. You've got a question and they go, so-and-so had bad debt, so-and-so is a cash basis taxpayer. His customer stiffed him of $5,000, okay? He wrote it off as bad, he didn't. The next year, he got paid $2,000 back, okay? You would have to count that $2,000 as income, but you didn't get to write off the $5,000 of bad debt because he was a cash basis taxpayer, right? So cash basis taxpayers don't really write off bad debt because they didn't count it as income. Example, taxable income, they got prizes, gambling, jury duty, hobby income, lots of stuff. You can read that as probably as well as I can or better. Okay, number 7, assignment of income. I have a wonderful son, and you owe me rent every month, and I go, just give it to my son, and he'll put it on his tax return. Wrong answer. It's my income. I have to count it as my income. I can give it to my son as a gift, but I still got to count it as my income. On the other hand, if I give him a gift of the rental property, then the income is his income. Okay? But I have to give him the gift. And what does that mean? I have to really give it to him. No wink and nod. I get it back when I want it, kind of thing. Assignment of interest income earned on securities. You can't do that, that would be the same, that's the same thing. I give my daughter the interest on the securities, it goes to her bank account. It's still my income. Effective assignment, okay. So if I transfer the property and it's complete and a bona fide, then no problem. No control is retained by me, I don't get to really, I don't own it anymore. Okay, so what happens if we issue bonds at a premium? I pay $40,000 for a bond over 10 years that it's gonna be worth $45,000 5 years from now. So $10,000, and we're just gonna say it's worth $12,000 in 5 years. So the difference of $2,000 in 5 years so that equals to, there's a bond premium of $400. Basically, I get $2,000 of interest. I pay $10,000, it's gonna be worth $12,000, right? So $2,000 divided by 5 years is $400 a year. If I get it halfway through the year, the first year is only gonna be $200. They caught me on one of these questions with that. The guy bought it in March, it didn't dawn on me, so I just did the math like this, and the wrong answer was right up in front of me. Oh, there it is. But, so in that case, it would be 400, but it would only be 3/4 of a year. So the first year, it would only be 300 that you would take as okay, the first year. They will probably have one of those. Okay, interest at a premium, self-employment income. What are self-employment income? What do we usually say? Schedule C, what? Schedule F, a partnership, guaranteed payments to a partnership. What else? You're a director and you get director's pay. I might have left something out.
Pastor.
What's that?
Pastor.
Pastor. Payments for lost earning, there's another one that I don't think of except when I do this class. So what happens if you win a lawsuit and they have to pay you for, I didn't get paid for the last year because you did something rotten to me, and you win the lawsuit and you get $40,000. They're just giving you 40. Well, you got to pay self-employment tax on that because you would have been paying. That's your lost wages. Okay, excluded, there's got a list here: salaries, rents, dividends, interest, S corporation shareholder distribution, fees reserved for as a notary public. They used to have that on there all the time. I don't know why, but they used to have notary publics don't have to pay self-employment tax.
So you
Okay.
don't include it as income?
Huh? Yeah, you gotta count it as income, it's just other income. It's not, they don't consider it a business. Although I know a lady that it is a business, that's her old business. She goes around as a mobile notary. In her case, I don't know, it might be a business. Okay. So how do we figure self-employment tax? So I make exactly 100 grand. And self-employment tax is what? 15.3%? Do I take, because I've missed this one before too, would I take 15.3% times 100 grand and that'd be my self-employment tax? No, because I get to subtract half of this as a deduction. And there's two ways to do it. One is you would take 7.65% from this, subtract it, and multiply that times 15.3. Or the other way, it's not in this book, but it's in other books, it's 92.35. So 92.35 times 100 would give you 92,350, and then multiply that times 15.3. Most likely they're going to have one of those on there. Does everybody understand why? Because look, on your tax return, you have 100 grand of net income, but on they used to be the bottom of page 1, still is, but not really. But you used to get to subtract half of your self-employment tax. Everybody remember that? So you subtract half of that, and then you multiply it. And that's the number that you multiply. And they have an example right here for you. On page 41. Then underneath that, if you make over 128,400, that's the maximum amount for Social Security. So what does that mean? Remember we had 15.3% here? So really it was 2.9 and 12.4. Does that sound right to you guys? 6.2 and 1.45. So, but this 12.4, if you make over 128,400 for 2018, just as you, by the time you learn that, it's going to change again, because 19 is almost here. Is anybody interested in learning about W-4s? In about 2 weeks, there's going to be you can go on an IRS webpage and get an update on how to calculate W-4s. If anybody's interested, let me know and I'll tell you how to do it. That's not part of this. Was okay, everybody get this? So, then what happens? After you pass the amount and you don't have the 12.4, then forever you're going to have to pay the 2.9%. Everybody got that part? Okay. What else? If by chance you make more than, for a single person or married filing separately, for a single person 200,000, for a married filing joint 250,000, married filing separately 125,000, then you've got to pay an extra 0.9%, a little bit less than 1% for what do they call it? Excess high income earnings. The employee's portion includes an additional 0.9%. So that's a little bit less than 1%. So they add that to it. But, and here's the problem, so it's only on the income for a single person above 200 grand. So if I had income of $250,000, I'd multiply that 50,000. It would be $450. 0.9% times 50,000, $450. Does everybody understand how that works? Your computer does this automatically. We don't even bother. Every now and then I go, oh, I forgot about that. Because the computer caught it and I forgot. But then when you're going over the tax return, you bring it to the attention of your client and you look like you know what you're doing. Question?
No.
Oh, somebody, you guys are not asking many questions.
So I have a question on that.
Okay, good.
So the additional 0.9, is that Social Security, is that Medicare? Cause Social Security tax is maxed at 120.
It's Medicare. But it doesn't go on the Medicare line. Let's see if I can tell you the number. I think it starts like 89. It's not 8,900, 89 something is the form. And it goes on your tax return. It's an additional tax. But
Is there a credit for that?
huh?
Is there a credit if you overpay the 9%? I thought I read something about that.
Credit.
Yeah, credit.
You could amend your tax return and get it back. If you paid that 9%,
If you overpay the
0.9%,
0.9.
yeah, you get it back. But I don't think, you're talking about a form, you know, like excess Social Security, you know, if you have worked for more than one employer and you pay
Yeah.
too much Social Security.
Like the FICA.
Yeah, but Social Security only stops at like 128,000. The Medicare doesn't stop no matter how much money you make. So there's no such thing as getting back Medicare like that. And if your income, the only way that could happen, because there's not, is if you have more than say 250,000 for a married couple, you got to pay it on everything above 250. So, but if you put down, you forgot to write off. You had your own Schedule C business, and you forgot to write off a bunch of expenses, and that made your income higher. You could amend your tax return and get it back, but I don't think there's a special thing. That's just amending your tax return. That would be, also you can see this in example 2.4. Under G, it says you can, self-employed people may deduct 100% of the amount for health insurance from gross income. Okay, the insurance can be for themselves, their spouse, or their dependents, right? Unless your spouse is covered by insurance at work, then you can't write off any of that, except as regular medical insurance on Schedule A. Contributions for qualified retirement plans for self-employed individuals do not constitute a business expense. So where do they go? They go on the front page of the 1040, right? They go down right about where medical expenses go. You know, everybody does know they're getting ready to change our forms again this year. We're gonna go back to the 2-page form, I believe. The good news, it'll confuse TurboTax people. Okay. So a contribution to, if you have employees and you put money into a retirement plan, that's a business expense for you. But if you're in that same retirement plan, you don't get to write that off as a business expense. You've got to take that off on the front page of your 1040.
But if you're a corporation, you could, right?
If you're a corporation, you could, but then if you're a corporation, you're an employee of that corporation. And so the employee could write it off. Same thing with an S corp. But there's limits. If you're more than a 2% owner of a S corp, I think you might be limited where your employees get 25%. You might be limited to 20%. And don't hold me to that, but I believe that's the right answer. What does that mean? If you're a self-employed person and you have a pension plan, you know that it affects, what it does is like taking that extra 7.65%, it does the same effect for you. So instead of you getting 25% of your wages, you'd only get 20%. If you have a pension plan and you were a Schedule C business and all your employees were getting 25% of their wages as a pension plan, you only get 20% as the owner. Same rule, kinda. It's not fair for the poor little starving owners. Just kidding. Let's go to forms. On page 42, the top part of 42, you're just gonna have to read this. I read it and I still don't understand it. I've never seen this before, but it's only, look, you can only have income of $7,900 and it nets out at 57. That's not really any of our clients in Hawaii much, unless you got some Waimanalo little bitty farmers. Okay. If you have a religious exemption for self-employed tax is available for duly ordained, commissioned, or licensed ministers. Everybody familiar with that? They have to fill out a form. And it's called 4361. They used to have that one on there on a couple of questions before, but not lately. You might want to know it anyway. What is the form you have to if you want to be exempt from Social Security? So what does that mean? So if you're a minister and you want to be exempt from Social Security, you can fill out a form and be exempt from Social Security. They don't have to take out Social Security for you. But what does that do for you? That means you're out of Social Security and you're going to starve when you get old. Unless your church decides to keep you around. Just don't do anything they don't like. Okay. Now we're going into farm income. Gross income from farming includes, amounts received from cultivation of soil, raising things, any kind of fruits and vegetables pretty much. Okay, gains from the sale of livestock, amounts received for livestock raised on the farm, purchase for resale. The basis of livestock is generally the cost of the animal. So, I have an animal, I buy him here, and I pay $1,000 for a cow. And I use it for breeding purposes. I'm going to keep it for a few years. I don't add all the costs like feed and everything to the basis of a cow. It stays at $1,000. Then if I sell it 4 years later for $1,500, I just had a $500 gain. If I sold it for $600, I'd have $400 loss. Everybody good with that?
There's no depreciation or.
Oh yeah, you could depreciate. I'm sorry, you get to depreciate over 5 years.
Livestock?
Yeah, but there's certain requirements. You got to buy them and sell them and keep them for. There's like 3 or 4 breeding. Hold on, let me just find it. Okay, farm assets not held for primary for sale. That means you didn't buy it to sell it, you bought it for breeding, draft, sport, or dairy purposes. You bought it for draft. You're going to draft it in the Army or draft beer? What is the word? I don't even know what the word draft means. But is everybody, you need to catch that because, okay, so I buy a cow to sell. That goes on the farm. I buy a cow to do breeding or sport. I buy a horse to run races. that is an asset, okay, and I would depreciate it, and then after, later on, I would sell it, and I could either have a gain or a loss. And where does that go? Probably on a 4797, it doesn't go on farm income. That is a question they've had on there for a long time. Does everybody catch the idea? And what is it? Breeding, draft, sporting purposes, or dairy. So you can have a dairy cow. Okay, rent received for the use of your farmland is general rental income, and that counts and it goes on the farm, on the Schedule F. Okay, all the sale of all the crops and stuff goes on there. And if you buy a bunch of cows just to resell, you fatten them up and then resell them, that goes on your Schedule F. It's just the ones you bought for other purposes, breeding, draft, sport, and dairy. Those are assets. You're gonna depreciate them, then write them off, and then sell them. You can buy stuff through a cooperative, and if you get dividends, it's income. Make sure you guys read all the chapters, because I'm not going through word for word. If the taxpayer produces real or tangible personal property or acquired property for resale, certain expenses must be included in the inventory cost. What would we talk about? I built a barn. Then you would have a barn that you would put all the cost in, and then you'd depreciate, right? Or I built a tractor, rebuilt an old beat up tractor, and then I sold it. Then I would start with the basis of the tractor, add all the repairs and everything to it, and then subtract, that would give you your cost. And if I didn't depreciate it, then I would sell it and I'd have a gain. Is that simple? This capitalization and depreciation does not apply to any plants that are productive period is 2 years or less. What does it take for most, is anything in Hawaii takes more than 2 years? Coffee? How long does it take you to grow coffee trees? I have no idea. Okay, so a farmer can deduct on your regular stuff, your barns, your fence would probably be part of the land, but any machinery that you bought, tractors, trucks, that kind of stuff, any other kind of equipment that you bought, you get to depreciate it. What can you not depreciate? Your house. I live on a farm, and I've got a barn here and a house next to it, and I live in my house. You can't depreciate your house. That's kind of normal.
I have a question.
Yep, go ahead.
What if you use part of the house as your home office for?
Well, then you could deduct that.
Okay.
Same rules if you have a house here and not on a farm.
I have a client that does breeding, and so she has a barn, and she breeds animals, and then she has another business where the home is on the same property, and
Okay.
she rents out, well, not rents out. She uses part of the home as a
Home office.
Yeah, home office.
No problem.
Okay.
That's just regular rules for office and home,
Okay.
which will be in chapter 4 or 5 coming up soon. It also says a lot of this stuff is just too easy. Farmer can also elect to use 179 and expense a portion of certain property bought during the year, just like anybody other business. Okay, there's a list of all these and what, but it says particularly, don't memorize all this. You're not gonna get that as a question. They're not gonna play gotcha. Or they would have got me. Okay, section 1231 gains. If you sell your farm or farm land, that's not farm income, that would be capital gains. Okay? Farm income averaging. Oh, we're rolling right along. Well, this, by the way, these are the easy chapters. They're
Thanks.
Well, no, that's what, then just in case you guys are still studying on the last part, all you had to do, basically, a lot of this is reading, and you should already know this. Okay, farm income averaging, a farmer or fisher. So, this also applies to fishing. He may be able to average all or some of his current year's farm income by using income rates from the 3 prior years. So what does that mean? So this year I made a bunch of money, but the last 3 years, if we average those last 3 years, I would be in a lower tax bracket. So I'd get to use a lower tax rate. That's called, there's a Schedule J that you gotta use. Schedule J's down a little bit. An individual or partner, a partner in a partnership, or a shareholder of an S corporation may elect income averaging. What you can't be is the partnership or a corporation or an S corporation elect income averaging. Do you see the subtle difference? An individual, a partner in a partnership, or a shareholder or a member of an S corporation.
Sorry, there's a mice inside the bathroom.
We have mice?
I ran inside.
Oh my God.
A mouse in the
It
bathroom?
was like, it saw me and then
It was more scared of you than you were of it. Okay, so I gotta make a note. We don't allow mouse in our bathroom.
it was small. It was small.
Huh?
It was small.
A small mouse?
Like,
Well,
That means there's a baby.
That means there's a big mouse with.
it's part of the neighborhood. No, we're connected to a big building over here and Ifuku radiator over here, and they can come up through this up here. But we have a method called a mouse trap. And we give it some cheese.
Peanut butter.
Peanut, that's what my son said. He said, and actually that works the best. That was about 6 months ago. And we haven't seen a mouse since then. They've now come back. Okay. So income averaging, what is it? Your, how many years? 3 years, your base year to calculate the tax on that income. An individual, a partner in a partnership, a shareholder in an S corporation. Okay. So, the taxpayer need not have engaged in farming business in any of the base years. So, this is his first year to be a farmer. In the last 3 years, he wasn't a farmer, but he still gets to do the Schedule J and get the lower rate. So, I was a poor, starving person doing whatever for the last 3 years, and this year, I started my own farm. I inherited it from my parents. I did really good. I can income average this year because my last 3 years were real low. I wasn't even a farmer. That's a good deal for somebody. If you can find that situation, you've just made a friend for life. You saved them a bunch of money. Okay, weather-related gains on the sale of livestock. Okay. So you can, gains from the sale of livestock caused by drought, flood, other related, say forest fires in California, or floods wherever they were, or snow up in, what was it, Montana? If you did have that, and it is eligible for assistance by the federal government, can be postponed for 4 years. If because of the weather-related conditions, a farmer who used the cash method of accounting sells more livestock than he would have normally, okay, he can postpone that gain in income next year instead of this current year. So he can include the gain in this year, or he can postpone it to next year. Who knows? The election applies to all livestock, whether held for resale or other purposes. It applies even if the livestock was actually exchanged or sold before it was designated for federal assistance, as long as the weather-related condition caused the exchange. So we had a drought, and I normally sell 50 cows, but I had to sell 100 cows this year because there was no feed for them. There's no grass. Does everybody get that part? Okay. Then I postponed the gain till next year. Save on taxes. Crop insurance and disaster payments are generally included in income. They go on the Schedule F. An election is able to include the proceeds in income for the tax year following the tax year in which the crops were damaged. So, we had a forest fire in California. It damaged all my wine grapes, bushes, whatever. So, I can, so I get to what? What would I do? Postpone it till the following year? So what do I have to do? The taxpayer must provide that the income from such crops would have been reported in the following year. The taxpayer must attach a statement to the return to verify this requirement has been met. That, they throw that into the test pretty much, so you need to know that. But this is really, you're gonna need to know on the last page here. Estimated taxes. Farmers get a special deal. What is it that they have to get that special deal? They have to have 2/3 of their income has to be from farming. And if it's so, then they can pay all their estimated taxes by January 15th and file their taxes by April 15th. Normally, for all the rest of us, we're supposed to be paying taxes every 3 months, right? Farmers get a special deal. Why do you think they get that? Because they don't know if their crop's gonna come in or it's gonna get flooded out or burn up or whatever. They also have another choice. They can pay everything by, what is it, March 1st? As long as they file and pay all their money by March 1st, boom, they're good. They don't have to pay any estimated tax. The third choice is what? They've got to either pay 100% of the previous year or 90% of this year. Wait, no, pay estimated tax by January 15 and then file a tax return paying an additional taxes by April 15th. It's the required annual payment is a smaller of 2/3 of the current year's tax or 100% of previous. Now for everybody else, it's 90% of this year's tax or 100% of last year. And if your income's over 150, it's 110%. So they get a little bit better deal. That's usually a question. Believe it or not, we're done. And here's a little, so also on there, it's, when you see the start here, it says if you owe under $1,000, don't worry about it. Will the farmer owe $1,000 or more into that after subtracting all the income tax, withholding and refundable credits from total tax? Okay? Don't subtract any estimated taxes. So if you don't owe $1,000, you're not gonna pay it, don't have to pay estimated tax. Okay, next week, these are gonna be somewhat, you better know, you should know this. Okay, so Chapter 3, just your regular business deductions. Chapter 4 is going to be like business meals, travel, insurance expenses, bad debts, business gifts. They're still at $25 for a business gift. So what do you have if you have a real estate salesman that just sold $1 million or $5 million home, and she only, you say, well, you can't give more than a $25 gift. And she says, if I gave them a $25 gift, they'd throw it in my face and tell me to get out. And that's literally what I've had people say. You want to give them some kind of promotional something, not a gift. Promotional, promoting your business in some way. This is a personal opinion. But the rule is, well, you can only give 25%. Okay, so those next two chapters are going to be somewhat easy. Then we get to 5 and 6. 5 is basis. And 6 is depreciation. So this next week is your easy week, then basis and depreciation, and then from then on it gets to be more of a challenge. If anybody does get behind, I'll be glad to help you. Up until we get to somewhere like November 13th, 14th, and 15th, I'll be out of the office. I'll be taking education. NATP is having 3 days of training. For you guys, you're not required because you're not an enrolled agent yet. But it's good learning. I don't know if you guys talk to your bosses and tell them, oh, you should send me to this stuff. Hey, money. All right. Any questions? We got off early tonight. This was easy.
Those seminars, do they qualify for the RTRT?
Huh?
Or the,
Yes, they do.
okay,
Except there is no more RTRT.
no, RTRT.
But I know what you mean. The answer
The
is yes.
AFTR or something
Yeah.
after. Okay. I don't know if I'm gonna pass all the 3 parts, or the next 2 parts, or the end of the year.
If you need help, I can help you between now and the end of the year. Piece of cake. After you.
After
I
church,
basically,
you have some
what I do is read the chapters before you guys, and then do the problems, the 30 problems at the back. So, if you can do that before you come in here, when we get to the tough part, that's the most you're gonna, you'll be okay. And if you don't get it, we can always give you some help. You guys want to stay and have a beer? He brought us a bunch of beer.
Thank you.
Huh? No. Yeah, but I don't have it. It's Lunch.
Dinner. Thank you.
Aloha.
Good night.
All right, come on, we'll have a cold beer.
Sounds good. How you doing?
I'm all right, except for,
Well, I wanted to play tennis tomorrow, but
You already got,
well, no, I'm working on I put in the new microwave and I had to readjust the cupboards and things, and so it's become more of a process. And all this, they're cleaning up because we're trying to get the place ready to rent out, so.
okay.
So if I go off and play tennis, she's gonna get. Are we out in the,
I got your beer over here.
Okay.
You can have chips though.
I'll bring them. So what's going on with this new legislation that they passed? Where is it only the city and state that have to use, union labor if the, cost of the project is over $2 million?
I don't know the real details,
Yeah.
but,
That's interesting, isn't it?
union labor mandatory. See this right here? This is the second page. I think she's scared that I'm taking her job, but she's been a little rough with me this tax season.
Has it?
Oh, Lord, you did this, you missed that. And she said, I did not include this. But I didn't, instead of doing that to her, that's good.
Yeah.
I just told you. Maybe because this was in your time. It was the actual, the last page of your federal. You didn't see it, but maybe I didn't tell you about it. I can't imagine that. But it could happen. I'm old.
Well, what's in store for next year? How are they doing?
To be determined. The whole world, Congress, is gonna probably, they can't even talk to each other to make a compromise. We brought something up to change, to make it easier on, so. You've got, because you're over 65, you get to deduct 13,600. Okay, so last year you'd itemize, or you would only written off about 7,000.
Yeah.
Okay? But you would have gotten another 4,000 exemption, so it would have been close to the same. But for people that have mortgages, property tax, pay a lot of taxes,
Yeah.
they get to itemize and have exemptions. Well, they don't get that now because of the tax. So, the House passed a law to bring some of that back to give relief to the lower and middle class. The Senate wouldn't hear it because it gives relief to mostly high-income, high-tax states. New York, Connecticut, Massachusetts, Maryland, Pennsylvania, Washington, California, Hawaii. Guess what all those states have in common? They're all blue states. Here's the bad part. The thing always been swinging back and forth. People are gonna hate if Trump can somehow win this next one, by the end of his 8 years, it will slam back the other way. Okay? Then payback's a bitch.
You don't think he's gonna play back this time?
I hope he does. And it depends, I'm seeing, I still see people today, who was it today? Say, you know, oh, beef truck.